Did you know that over 55% of Americans have money invested in the stock market, either directly or through funds? Yet, a staggering number of people jump in without understanding what they're diving into. Imagine skydiving without knowing how to open your parachute. That's how risky uninformed investing can be. But here's something even more surprising. If invested wisely, just $1,000 in the stock market 30 years ago could be worth over $20,000 today, thanks to the power of compounding interest. And get this, Warren Buffett, one of the wealthiest individuals on the planet, made 99% of his current wealth after his 50th birthday, all through smart investing. These numbers aren't just digits, they're a testament to the transformative power of investing. Yet, for every success story, there are tales of missteps and missed opportunities. Why? Because while the barrier to entry has never been lower, the complexity of the market has never been higher. But fear not, you're about to embark on a journey that demystifies the stock market, making it accessible, understandable, and, dare we say, even enjoyable. From grasping the basics of the stock market to mastering the art of diversification and risk management, we're here to guide you through each step. Whether you're saving for retirement, a dream vacation, or just aiming to grow your wealth, understanding how to pick your stocks is your first step towards financial freedom. So, buckle up, you're not just watching another investment video. You're setting the foundation for your financial future. Let's dive into the world of investing, one smart decision at a time. Chapter 1. Introduction to the stock market. When you hear stock market, what comes to mind? Busy traders, big screens, and a lot of numbers, right? But at its core, the stock market is simply a place where shares of publicly traded companies are bought and sold. Think of it as a massive, global marketplace, not too different from your local farmer's market, but instead of buying apples, you're buying pieces of companies. Did you know that the New York Stock Exchange, one of the largest stock exchanges in the world, was founded way back in 1792? And here's a fun fact: the first stock traded was the Bank of New York. Fast forward to today, and millions of shares change hands every second. This evolution from a small gathering under a buttonwood tree to digital trading platforms is a testament to the stock market's integral role in our economy. Investing in stocks allows you to own a slice of a company. If the company does well, so do you. But it's not just about picking winners, it's about understanding the market's ebb and flow. The stock market reflects the collective actions of all its participants, from individual investors to massive institutions, all reacting to news, economic indicators, and company performance. So, why invest in stocks? Over the long term, stocks have historically provided higher returns than other investments like bonds or savings accounts, though with greater volatility. The key to success in the stock market is not just picking the right stocks but understanding the market itself. Chapter 2. Understanding your investing goals. Setting goals might sound like the beginning of a New Year's resolution, but when it comes to investing, it's where the magic starts. Your investing journey should begin with a simple question: what am I investing for? Whether it's retirement, buying a house, or just growing your wealth, your goals will shape your investing strategy. Think about when you need the money you're investing. If you're saving for retirement 30 years from now, you can afford to take more risks compared to if you're saving for a down payment on a house in the next few years. This is because, in the long term, the market tends to smooth out the short-term ups and downs. It's also crucial to consider your risk tolerance. Are you someone who can watch your investments drop by 20% and not panic? Or does even a 5% dip make you nervous? Understanding your comfort level with risk will help you build a portfolio that won't keep you up at night. Lastly, don't forget to set realistic expectations. The stock market isn't a get-rich-quick scheme. It's about consistent growth over time. Did you know that the average annual return of the S&P 500, a stock market index, has been around 10% before inflation? That's a far cry from doubling your money overnight, but it's a solid strategy for building wealth over time. Investing is a personal journey, and setting clear, achievable goals is the first step. With your goals in hand, you're ready to dive deeper into the world of investing. Chapter 3. The importance of research. When it comes to investing, jumping in without looking can be like trying to swim with an anchor tied to your feet. Doing your homework is not just recommended, it's essential. You wouldn't buy a car without checking its history, right? The same goes for stocks. Research is your best tool for uncovering the gems that can add real value to your portfolio. Start with the basics. What does the company do? It might sound obvious, but understanding a company's business model, its products or services, and its place in the industry can give you a clear picture of its potential. From there, dig into its financial health. More on that in the next chapter. But where to get this information? The internet is your library. Company websites, financial news sites, and even social media can provide insights. However, not all sources are created equal. Look for reputable financial news outlets and official company publications for the most reliable information. Another key aspect of research is learning to read market sentiment. This means getting a feel for how other investors view the company. Are there recent news articles praising the company's innovation, or are forums buzzing with concerns about its leadership? Market sentiment can significantly influence stock prices, sometimes regardless of a company's actual financial performance. Lastly, don't overlook the importance of patience. Good research takes time, and impulsive decisions can lead to mistakes. Remember, investing is a marathon, not a sprint. Did you know that Warren Buffett, one of the most successful investors of all time, spends 80% of his day reading and thinking about investments? There's a lesson in there about the value of diligent research. Chapter 4. Analyzing financial health of companies. Imagine you're considering lending money to a friend. You'd probably want to know if they have a job, how much they earn, and if they have other debts, right? Analyzing a company's financial health before investing is a similar process. It's about ensuring the company is financially sound and capable of growing your investment. The first stop is the income statement, which tells you how much revenue the company is generating and its expenses. Look for trends. Is revenue growing? Are profits keeping pace, or are expenses cutting too deep? These trends can indicate whether a company is on the upswing or facing challenges. Next, check out the balance sheet. This is where you'll find a snapshot of the company's assets, liabilities, and shareholders' equity. A strong balance sheet usually has more assets than liabilities, showing that the company can cover its debts and has room to invest in growth. Don't forget the cash flow statement. Cash is the lifeblood of any business, and this statement shows how much cash is coming in and going out. Even profitable companies can struggle if they don't manage cash flow wisely. Positive cash flow indicates that a company can sustain its operations and invest in its future. One tip for beginners: look for companies with a strong moat. This term, popularized by Warren Buffett, refers to a business's ability to maintain competitive advantages over its rivals, ensuring long-term profitability. It could be a patent, a strong brand, or exclusive access to resources. Remember, numbers tell a story, but they're just one part of the puzzle. Combining financial analysis with your research on the company's business model, market position, and industry trends will give you a comprehensive view of its potential as an investment. Chapter 5. The role of market trends and economic indicators. Navigating the stock market can sometimes feel like trying to sail without a compass. That's where understanding market trends and economic indicators comes in handy. It's like having a map and a compass in one. These tools don't predict the future, but they do provide signals about where the economy and stock market might be heading. Market trends can be your guide in understanding the general direction in which the market is moving. Is it in a bullish phase, where everything seems to be climbing? Or is it bearish, with prices generally falling? Identifying these trends can help you make more informed decisions about when to buy or sell. Economic indicators are like the weather forecasts of the economy. They can include metrics like unemployment rates, inflation, and gross domestic product, GDP, growth. For instance, high unemployment may signal economic trouble, potentially affecting the stock market's overall performance. On the flip side, strong GDP growth can indicate a healthy economy, often correlating with a robust stock market. Here's a pro tip: keep an eye on the Federal Reserve's actions, especially interest rate changes. Lower interest rates can boost economic activity by making borrowing cheaper, often leading to stock market gains. Conversely, when rates rise, borrowing costs increase, possibly cooling off an overheated market. Remember, though, that these indicators and trends are just part of the bigger picture. They should inform, not dictate, your investment decisions. Investing based solely on trends or predictions can be risky. Always balance this information with your research and financial analysis. Chapter 6. Diversification. Why it matters. Never put all your eggs in one basket. This age-old wisdom applies perfectly to investing. Diversification is the practice of spreading your investments across various assets to reduce risk. It's like having a safety net, ensuring that a fall in one area won't wipe you out. But diversification isn't just about owning different stocks. It's about spreading your investments across various sectors, like technology, healthcare, and energy, and asset classes, like stocks, bonds, and real estate. This strategy can help protect your portfolio from volatility, as different sectors and assets react differently to economic changes. For example, during an economic downturn, consumer staples, like food and household products, often perform better than luxury goods, as people prioritize necessities. By diversifying, you can mitigate the impact of sector-specific downturns. Moreover, consider geographic diversification. Investing in international stocks or funds can expose you to growth in other economies, further spreading your risk. Did you know that many of the world's fastest-growing economies are outside the United States? However, international investing also brings additional risks, like currency fluctuations and political instability, so it's crucial to do your homework. Diversification isn't about eliminating risk, it's about managing it. The goal is to construct a portfolio that can withstand market shocks and generate steady returns over time. Remember, diversification is a strategy for the long haul. It's about steady growth, not chasing the next big thing. Chapter 7. Risk Management Strategies. Investing in the stock market is not without its ups and downs. It's thrilling when your investments soar, but what about when they take a nosedive? That's where risk management comes into play. It's all about having strategies to limit potential losses, ensuring you can weather the storm and stay in the game. One key strategy is setting stop-loss orders. This tool allows you to set a specific price at which your stock will automatically sell, preventing a small loss from becoming a financial disaster. It's like having a safety net, ensuring you don't fall too hard. Another technique is position sizing. This means not investing more than you can afford to lose in a single stock or sector. A general rule of thumb is that no single investment should represent more than 5–10% of your total portfolio. This way, a loss in one area won't significantly impact your overall financial health. Also, consider the use of options for risk management. Options can provide a way to hedge your investments, acting as insurance against drastic price movements. However, they're complex financial instruments that require a good understanding before use. Chapter 8. Long-term versus short-term investing. When diving into the world of investing, it's crucial to understand the difference between long-term and short-term investing. Each approach has its merits and pitfalls, and choosing the right strategy depends on your financial goals, risk tolerance, and patience level. Long-term investing is all about patience and vision. It's for those who invest with a horizon of several years, or even decades, in mind. This strategy is based on the belief that, despite short-term market fluctuations, investments in solid companies will grow over time. It's like planting a tree and waiting for it to bear fruit. Did you know that historically, the stock market has returned an average of about 10% per year over the long term? This approach benefits from compound interest, where your investments grow exponentially over time. Short-term investing, on the other hand, is more about agility and taking advantage of market fluctuations. It requires a lot of time, attention, and a higher tolerance for risk. Short-term investors, or traders, aim to buy low and sell high over periods ranging from days to months. While this can lead to high returns, it also comes with greater volatility and the risk of significant losses. Both strategies have their place, but for most beginners, long-term investing is often the safer and more straightforward path to achieving financial goals. It allows for a more passive approach, where time in the market, rather than timing the market, leads to success. Chapter 9. Common pitfalls and how to avoid them. Investing can be an exciting journey, but it's easy to stumble along the way. Being aware of common pitfalls can help you navigate the path to financial success with fewer missteps. Let's talk about a few and how you can sidestep them. First up, chasing hot stocks. It's tempting to jump on the bandwagon and invest in a stock just because it's making headlines or your friend made a quick buck. However, by the time a stock is hot, you might be buying at the peak, right before the fall. Instead, focus on the company's fundamentals and long-term potential. Another trap is overreacting to market volatility. The stock market has its ups and downs, but knee-jerk reactions can hurt your investment goals. Remember, investing is a marathon, not a sprint. Keep your eyes on the horizon, not the waves at your feet. Ignoring fees can also eat into your returns. Whether it's brokerage fees, fund management fees, or transaction costs, make sure you understand what you're paying. Sometimes, what seems like a small fee can add up over time, significantly impacting your investment returns.